Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 149, and in this episode, we are reviewing the performance of the global markets during the 9th week of 2025, and that is from Monday the 24th to Friday the 28th of February. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where according to a report from the Commerce Department that was released on Friday, the rate of inflation in the United States eased off slightly by 0.1% in the month of January as concerns persisted over President Trump's trade tariffs. The Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred measure for inflation, this increased by 0.3% for the month and recorded an annual rate of 2.5%. Excluding food and energy prices, the Core Personal Consumption Expenditures Price Index also rose 0.3% for the month and came out at 2.6% on an annual basis, down from an upwardly revised rate of 2.9% in December. For your information, Fed officials consider the Core Personal Consumption Expenditures Price Index as a better indicator of longer-term inflation trends. The inflation numbers came out in line with the consensus estimates, and this will probably keep the Federal Reserve on hold for the time being with regards to its policy rate. An update on the ongoing issue of trade tariffs. On Thursday, President Trump announced that his proposed tariffs on Mexico and Canada will go into effect on the 4th of March, and an additional 10% tariff would be levied against China on the same date. The sweeping 25% tariffs on imports from Mexico and Canada had initially been put on hold on the 3rd of February, but have now been reactivated. Trump also announced that China, which already faces a 10% tariff on its exports to the United States, will be charged an additional 10% tariff, which means that U.S. tariffs on Chinese imports will now total to 20%. In addition to the above, Trump confirmed that the issue of reciprocal tariffs, which take effect on the 2nd of April, remains in full force and effect. Staying in the United States, according to a report from the Federal Reserve Bank of Atlanta, early economic data for the first quarter of 2025 is pointing towards negative growth in the United States. According to an update posted on Friday morning, the central bank's GDP tracker is indicating that the gross domestic product is on pace to shrink by 1.5% for the first quarter of 2025. And to mark the third anniversary of Russia's invasion of Ukraine, the United States has proposed its own United Nations resolution after refusing to back one drafted by Ukraine and backed by Europe. The draft U.S. resolution does not condemn Russia as the aggressor in the conflict, nor does it make any acknowledgement of Ukraine's territorial integrity. The ongoing war in Ukraine has raised serious questions about Europe's security, and the lack of American support for Ukraine this past week has only exacerbated this concern. On Wall Street this past week, stocks wrapped up a volatile week that saw all the major indices record a losing month in February. Friday's trading session saw a brief pullback after President Trump and Ukrainian President Zelensky clashed in the Oval Office, which raised concerns about heightened geopolitical risks. All the three major benchmarks turned negative for a short period on Friday following the spat between the two presidents. Stocks, however, rallied sharply into Friday's close, with the tech-heavy Nasdaq Composite climbing by 1.6% to settle at 18,847, whilst the S&P 500 declined roughly 1% for the week and was down by 1.4% in February and came to a close at 5,954. And last but not least, the Dow Jones Industrial Average rose by about 600 points on Friday and was up about 1% for the week, but dropped 1.6% for the month to eventually end the session at 43,840. In the Treasury bond market, the price of U.S. Treasury bonds jumped on Friday after a spat between President Trump and Ukrainian President Zelensky that raised concerns over growing geopolitical tensions. Investors quickly fled riskier assets such as stocks after the news of the argument came to light. Treasury yields had been under pressure earlier in the session after the release of U.S. inflation data that came out in line with market expectations. The yield on the benchmark 10-year Treasury bond fell 6 basis points to 4.22%, whilst the yield on the policy-sensitive 2-year Treasury note was down more than 8 basis points to close at 3.99%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil fell about 1% on Friday, posting its first monthly drop since November as markets braced for President Trump's trade tariffs that will take effect from the 4th of March. On Thursday, President Trump confirmed that he was proceeding with the 25% tariffs on Mexico and Canada, along with an extra 10% duty on Chinese imports. For your information, the threat of a tariff war could slow down global economic growth as well as spark inflation and in turn suppress demand for crude oil. Meanwhile, there is increasing uncertainty about whether the Organization of Petroleum Exporting Countries will decide to raise oil production in the month of April as previously planned, or opt to hold back for the time being as members struggle to determine the global supply picture. In response, the price of the global benchmark Brent crude fell by 86 cents to close at $73.18 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this was down by 59 cents to settle at $69.76 per barrel. In the precious metals market, the price of gold fell over 1% on Friday as the dollar held close to a 2-week high after U.S. inflation data came out in line with market expectations, suggesting that the Federal Reserve may continue to hold out on additional rate cuts. The price of bullion was impacted by profit-taking as well as a strong US dollar index that makes gold more expensive for buyers using other currencies. Higher interest rates tend to dampen the appeal for this non-yielding asset. However, the safe haven appeal for gold has delivered a second consecutive month of positive gains that was boosted by geopolitical tensions and the concerns over Trump's trade tariffs. The price of spot gold lost about 3% for the week to eventually settle at $2,846 per ounce. And in related news, there is a growing demand for physical gold in the United States as institutional investors increase their stockpiles of bullion before President Trump's tariffs kick into high gear. According to data provided by the World Gold Council, more than 600 tons, that is equivalent to almost 20 million ounces of gold, has been transported into New York City since December 2024. In the cryptocurrency market, the price of Bitcoin fell sharply during the week, dropping from around $96,000 to just below $80,000 on Friday. From its all-time high of $108,000 that was hit in mid-December 2024, the price of the flagship crypto asset was down about 25%, reversing most of the gains made following the election of President Trump. After falling below 80,000, the price of Bitcoin turned positive on Friday after the latest US inflation data came out in line with market expectations. Despite the recovery, the price of the flagship crypto was still down by more than 11% for the week and was on track for its worst week since the collapse of FTX in November 2022. Investors have been avoiding risky assets given the weakness in global equity markets and amid uncertainty on U.S. trade tariffs, as well as unresolved geopolitical tensions in Ukraine and Gaza. Nevertheless, most crypto investors remain bullish on Bitcoin's outlook as they await a clear regulatory framework from the Trump administration. According to CoinMetrics, the price of Bitcoin fell to a low of about $78,000 earlier in the week before recovering to close the week at just above $84,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where the official data shows that headline inflation increased to 3.5% in February 2025, up from 3.3% in January, and this was largely due to an increase in non-core inflation. Non-core inflation, which is a measure of volatile food and energy prices, increased from 7.1% in January to 8.2% in February. This increase in non-core inflation was mainly driven by higher vegetable prices. Meanwhile, core inflation, which excludes volatile food and energy prices, remained unchanged at 2% flat. In the domestic foreign exchange market, during the past week, the Kenya shilling appreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.31 compared to 129.45 that was recorded the previous week. Meanwhile, the sterling pound was priced at 163.61 and the euro was valued at 135.28. And on the regional front, one Kenya shilling was changing hands for 28.45 Ugandan shillings and 20.06 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.82. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined significantly by $199 million for a grand total of $9.057 billion, which is equivalent to 4.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, the interbank market was sufficiently well funded, and this was mainly due to the recent reduction in the cash reserve ratio and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by 7 basis points from 10.68% the previous week up to 10.75%. And in terms of volume, the average value that was traded in the interbank market, this decreased to 14 billion shillings, down from 22.7 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the new cash reserve ratio of 3.25%, this stood at 19.1 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 27th of February, and the central bank received bids totaling to 36.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 152%, and the results of the auction were as follows. The 91-day rate dipped by just 1 basis point to average out at 8.93%, whilst the 182-day rate declined by about 7 basis points to level off at 9.23%, and the 364-day rate slipped by 2.6 basis points to settle at 10.50%. At the Nairobi Securities Exchange, during the month of February, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 6.4%, whilst the NSE 25, the NSE 10, and the NASI gained by 4.6%, 4.1%, and 3.0% respectively. The market's positive performance was driven by gains recorded by large cap stocks such as DTB Bank, Stanbic Bank, and Standard Chartered Bank, whose shares increased in value by 11.4%, 9.5%, and 7.8% respectively. This monthly performance was however weighed down by losses recorded by other large cap stocks such as Bamburi, which declined by 4.6%. Meanwhile, during the week, the Nairobi Securities Exchange announced a suspension in the trading of Bamburi Cement shares effective the 27th of February until the 9th of May 2025. The suspension on trading of Bamburi shares was enacted following the successful acquisition of 96.5% of Bamburi shares by Amsons Industries Kenya Limited. The suspension was put in place to facilitate the squeeze-out process for Amsons to acquire the remaining 3.5% of Bamburi shares. And also happening this previous week, Procter & Allen, a leading cereals manufacturer, was placed under receivership due to a loan of 3.7 billion shillings from Kenya Commercial Bank. The company has struggled with competition and economic downturns that were exacerbated by its relocation from Nairobi to Limuru. The High Court has appointed joint receivers to oversee the restructuring of the company. In the international markets, during the month of February, the yields on Kenya's Eurobonds were on a downward trajectory, with the yield on the 7-year 2019 Eurobond decreasing the most by 115 basis points from 8.4% recorded at the beginning of the month down to 7.2% at the end of February. Up next is our topical issue, and this week we're looking at Kenya's foray back into the Eurobond market. Like a moth to a flame, or more like a junkie in need of a fix, Kenya was back again in the Eurobond market this past week and successfully managed to raise $1.5 billion at a rate of 9.5% after receiving overwhelming support from investors who put in bids totaling to $4.9 billion. The new Eurobond, which has a tenor of 11 years and will mature in March 2036, was floated to provide funding for the buyback of the 2019 Eurobond for $900 million that was issued at a rate of 7%. The 2019 Eurobond was an amortized bond, which means that the repayment was staggered, and in this particular case, it was split into 3 equal installments of $300 million, starting in May 2025 and continuing into May 2026, with the final repayment coming on maturity in May 2027. The issuance of the new Eurobond will enable the Treasury to refinance the full amount in one bullet repayment. Given that the new Eurobond raised $1.5 billion, out of which $900 million will be used to repay the 2019 Eurobond, that means that the Treasury has raised an additional $600 million that will go towards general budgetary support as part of the Treasury's external borrowing target of 280 billion shillings for the current fiscal year 2024-2025. And just for your information, following the partial buyback of the $2 billion 2014 Eurobond in February last year, this was the second Eurobond buyback that the Treasury has implemented in as many years. The only difference being that this time around, the Treasury added an additional $600 million to our national debt, which according to analysts is already unsustainable. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, prioritize your personal development over your job. Think about it. Thank you, and God bless.